If you're looking at the sea of red in tech today and panicking, you're looking at the wrong side of the market. Right now, a massive silent capital rotation is happening right under retail's nose. While everyone is distracted by the AI CapEx panic and the brutal global semiconductor dump ahead of big tech earnings this week, institutional money isn't leaving the market, it's just moving. We are seeing a textbook flight to safety. Billions are being ripped out of the high-flying tech darlings and aggressively parked into boring defensive sectors, high-yield dividends, and equal weight indices. Today, I'm going to show you exactly where the smart money is hiding, the specific ETFs catching this massive wave of capital, and how you can position your portfolio to ride the rotation before the retail crowd catches on. If we just start with taking a quick look at the Semiconductor index, we can see we are down by almost 5%, and the market hasn't closed yet. It looks like we're about to have the first close below the cloud, telling us this could be the start of a real major downtrend. Lagging span is still above price, but the cloud is growing in size and bearishness. The only saving grace at this point would be the neckline here before we start to anticipate real downside targets. The catalyst here is a combination of massive fears hitting the market. First, the AI CapEx reality check, as you can see in this headline. The Magnificent Seven tech giants lost nearly $800 billion on Thursday, and this was led by Google reporting their earnings. And although Alphabet delivered strong revenue growth and highlighted growing cloud services backlog, investors focused on its sharply higher infrastructure AI spending, triggering a sell-off in the stock. And this was mainly due to ramping up capital spending to capture the AI opportunity, raising it by another $15 billion. So it's clear hyperscalers are spending unprecedented amounts on AI infrastructure, and Wall Street is suddenly demanding to see the return on investment. And until these tech giants can prove their AI revenue matches their spending, the hardware makers are going to get dumped, especially when we have important earnings this week in Microsoft, Meta, Apple, and Amazon. And as discussed before, we're seeing a broader semiconductor sector sell-off, pushing down over 20% from its June highs. When you see a high momentum sector like this snap its long-term uptrend, that's institutional de-risking, as we're looking to confirm the close below the cloud here. And Apple was definitely a stock that we were watching on this channel a few weeks back. Feel free to go back and look at the videos. And while it was purely a technical setup, there are definitely now fundamentals backing up the trade, with people suggesting that Apple could be the anti-CapEx AI trade, as Alphabet is forecasting around $205 billion and Apple have spent less than $2 billion over the same period. Apple also have overtaken Nvidia and is now the largest company by market cap, which probably comes amid fears of circular funding. Memory had a bigger drop than semiconductors, and while pretty much everything in the market is bearish, we've had CXMT becoming China's most valuable listed company after blockbuster Shanghai debut, with CXMT being China's top DRAM maker, with the market reading that as a threat to Micron, SK Hynix, and Samsung, with them all being below the cloud, apart from Micron, which seems to be just about hanging on. However, I wouldn't imagine that it does, as the cloud is thinning out and threatening a bearish twist. There are also reports suggesting that CXMT is entering the DUV lithography business, threatening ASML, which is also below the cloud and bearish. If your portfolio is heavily focused on the AI build-out, it might seem like the whole world is crashing. There are definitely sectors that are still looking bullish, and it's about capturing those rotations. Admittedly, the S&P 500 looks to be struggling here too. While this is looking like it's about to close positive at less than 0.5%, the real story here is in the Russell, which is currently up 1.11%. We're looking to have negated the momentumlessness, as you can see here, as the Tenkan and the Kijun are both pointing up, as well as the cloud and the cloud being bullish, and lagging span is above price. I've actually had to draw the targets back on because I didn't think that we were going to make those targets due to bearishness in the rest of the markets, but it's looking like we might be able to do that. We've got about 3.34% left. And with this, we can see that the broader market is exceptionally healthy. The weakness is entirely concentrated at the very top of the information technology sector, with IGV being neutral and looking like it's having a similar day in terms of its price movement to the S&P. The Nasdaq is also experiencing some strong downward momentum, as you can see by the Kijun line and the Tenkan line pointing downwards, as well as the cloud being bearish and pointing down, and lagging span is in the cloud. The positive news here is that we've managed to close below the cloud for USO, which is oil, thereby negating any bullishness that we've seen here at the break of the cloud. And this comes with the Middle East tensions easing and the US 10-year government bonds falling. This is great because it helps cool down the inflation fears, just as investors are bracing for a hawkish Fed meeting, with uncertainty growing about what the central bank could decide about the direction of monetary policy. However, 70% of the people think that we'll stick with the current interest rate. So, where are those billions of tech profits going? They're rotating into the ultimate sleep at night sectors. And as you can see, the financial media is starting to report investors are aggressively shifting attention toward more defensive areas like healthcare and consumer staples. With consumer staples having flagged up on my screen here this week, and it looks like it wants to break out of this base here. There's this neckline here that we're trying to test as resistance, but other than that, everything is bullish, with price being above the cloud, lagging span being above price, and the Kumo cloud being bullish and thick. Consumer staples are the boring companies that make the slower moves, and I'm not suggesting that we should throw all our money into consumer staples, but for sure there could be an allocation to it, and it works as a defensive rotation as well. But I think it's good to have a little bit of exposure to the industry. From the ETF, we've got eBay, which looks ready to test the neckline here. Lagging span is above price, and the cloud is looking like it wants to turn bullish again, and the chart looks ready for all-time highs. Chewy, which is bearish on the weekly, is definitely showing signs that it might break above the cloud, and it could be an early trend reversal. The cloud is flipped bullish, and lagging span is above price. TSCO, which is the tractor supply company, looks extremely bearish on the weekly, but we can see it's overbought, which I can tell by the distance between the Kijun line and the Tenkan line, but it looks like it's been consolidating for a few months here, and personally I'm waiting for a breakout, as lagging span is above price, and the cloud is bullish, and I'm just waiting for a break of the neckline and a close above the cloud. National Vision Holdings, with the ticker I, again doesn't look like it's doing much on the weekly, but on the shorter term it looks like we're starting to close above the cloud. The cloud is twisting bullish, and lagging span is above price. MNRO doesn't have much going on the weekly, and neither the daily, but I like that it's been consolidating for a while sideways, and I'm waiting for a close above the neckline here. And by that time everything should be bullish. And those are just some of the setups that I'm looking at for the XRT. It looks like it's closing positive by around 2.2%, big difference compared to the Nasdaq. We've also been following XLV as well, which is closed at 2.39% today, which again is currently outperforming tech. We've also been tracking XLF, which has now confirmed the close above the neckline. However, in terms of relative volume, I'm not seeing too much there. And it's in times of economic uncertainty and rate decision anxiety, institutional capital floods into companies that sell things people have to buy regardless of the economy. And you can tell from the price action this has been building up for some time. XDV is still there in terms of volume, but it's nothing we haven't discussed before. The only new addition in terms of relative volume is the Schwab Dividend Equity ETF. So it's clear to me that investors are locking in guaranteed yield and solid fundamentals. So I think if you want to survive the market turbulence, we've got to follow the smart money. So either majority cash or safe positions are probably the way to win right now. I've also had a few stocks flag up on my individual stock screener, and for the most part they are actually in alignment with the broader rotation that we've just discussed, and I'll quickly run through them. There's AMGN, which looks like it wants to cross above the neckline here. On the daily it's looking like it's rounding here, which is a bullish sign. We've just had a break above the neckline, lagging span is above price, the conversion line and the baseline are pointing up, indicating strong momentum, and the cloud is bullish, with a decent target ahead. GPK is bearish on the weekly, however it looks like it's about to break out of this consolidation here, with a close above the neckline, lagging span is above price, the conversion line and the baseline are both pointing up, indicating strong bullish momentum, and the cloud is bullish as well, with the 17% move projected here. THC is an all-time high breakout, closing above the neckline here, and we're seeing some follow through on the initial gap up here. The conversion line and the baseline are both pointing up, lagging span is above price, and the cloud is bullish, with quite a decent target ahead. The black line is bearish on the weekly, but looks like it's about to break out this consolidation on the daily. With a close above the neckline here, the cloud is bullish, and lagging span is above price, with a decent one-to-one move here projected. However, there's some resistance there, and we've got significant volume at these levels here. And I won't go into too much detail on this one, but this was brought up as well last week. Cinemark Holdings had a base breakout as well, with a decent target projected, and looking like it's following through on its diagonal breakout. If you found any value in today's video, please like, comment, share, and subscribe.